Hey, what's going on, traders? Thanks for checking out this video. My name is Travis from Master the Market, and this is going to be a quick video talking a little bit about swing trading. And I'm actually going to be giving you a swing trading strategy that I've used for several years in my own trading. And in my experience, this has been a very consistently profitable strategy. So let's go ahead and get right into this gap close reversal strategy, and I'll explain to you what exactly it is and how it works. Now, in order to get into the strategy itself, it's important to actually understand what exactly a gap is in the stock market and to know exactly how they actually form. So I have an example here of Netflix's stock, and if we look over here on the left side of the screen, this is the daily chart for Netflix. So every single one of these candlesticks is representing one entire day of price action. And if you look actually a couple of weeks ago, you can see that there was a big gap in the stock from about $550 per share all the way down to the next day, the low 500s. Now, the primary reason that these gaps actually form in the stock market is because when you're looking at the daily chart simply shows you the price action that happened within the market hours. So anything that happens in after hours or anything that happens in pre-market is not going to be displayed on that daily chart. And because a large majority of the time a company is going to release news in after hours or in pre-market, which is the extended hours period, that's going to cause a lot of movement that actually happens in extended hours that is not going to be shown on that daily chart. So for example, when we look at Netflix on this day, over here is the 5-minute chart, and this gray section on the left side of the screen is actually going to be that extended hours period that is not shown right here on this daily chart. So this big sell-off to the downside that we see in Netflix on the 5-minute chart again is not going to be shown on this daily chart and is then going to just appear as a big gap or a big empty space on the daily chart once the market opens for the day. And in Netflix's case, this happened because the company put out their earnings report, and for the first quarter of this year, Netflix was reporting that they have a significant slowdown in their growth of subscribers, which obviously the market took as bad news and the price of the stock fell down. Okay, so now that you have a little bit of understanding what gaps are in the stock market, believe it or not, there are quite a few different ways and different strategies that can be applied to these gaps for both day trading and for swing trading. Now in this one, we're going to talk about the gap close reversal strategy, which is primarily used for swing trading, but you can actually use it for day trading as well. And because gaps do present so many different trading opportunities in the market, I actually do have several other different videos going over different trading strategies already posted on my channel, so I'll go ahead and link those down below in the description. But to summarize here, what we're looking for this specific gap close reversal strategy, we first want to see that there is a big gap on the daily chart. And the whole idea behind the strategy is that gaps do tend to fill over time. So whether that be a few weeks later or a few months or even a few years later, that gap is most likely going to fill up to $550 per share, in this case for Netflix. And at that point, what we would look for in the stock is a reversal back to the downside from that price level. Now, because most traders aren't really that interested in short selling, which would allow you to sell high up at 550 and then profit from that reversal coming back down to the low 500s, ideally what you're going to see is that the gap is actually going to be below. So that way, once the price fills that gap to the downside, that gap close is going to become a level of support and the price is going to bounce back up for you to buy into and then actually profit from the price going back up after that gap close reversal does happen. So another quick example of that is if we look at Microsoft's chart, we can see here if we look back in the past couple of months that there are a few examples actually of a gap close reversal that would have offered some really great swing trading opportunities for Microsoft. First, if we look over here, we can see that there is a gap here from about $205 per share up to the following day about $212. Just a few days later, the price pulls all the way back down, actually fills that gap to the downside, and spikes back up, recovering all the way back up to that 212 high, and actually goes significantly higher, way up to over $230 per share. So again, the idea is that you're going to look for this gap to fill, and you're going to look to buy into the bottom range of that gap, anticipating that the stock is going to bounce back up once that gap in the daily chart is then filled by price action. Okay, so if we go ahead and fast forward just a few months here, still looking at Microsoft's chart, you can see again there's another example where there is a gap to be filled down here at about $208 per share. Most likely the reason for this big gap up here is some kind of news that was released in extended hours by Microsoft. But regardless, over the next couple of days and couple of weeks, the price pulls all the way back down to that gap close reversal point at $208 per share. And you can see in this case that that $208 acted perfectly as a level of support. So once it got down to that 208 level, the stock started to perfectly bounce from that price. And we can see over the next couple of weeks and couple of months that it actually ended up forming a strong uptrend off of that price level, which would have been a really great swing trade opportunity for anybody looking for that gap close reversal to buy into. Now, another quick example to show you that this is not just going to happen in the really well-known and the higher price stocks, which are known as blue chip stocks. So like Apple, Amazon, Facebook, Google, those types of stocks. But we do actually see this happen pretty commonly in penny stocks as well. And if you're interested in trading penny stocks because of the potential for much larger returns, a really great example of this that I noticed is going to be here on the chart for DPW. So if we go way back nearly to a year ago, you can see that there was a big gap up in this chart from about $1.50 all the way up to the following day of over $3 per share. So if you happen to be watching this stock and you were looking for a potential price to buy into it, the gap close reversal point is going to be down at $1.50, which is of course where the price was at before it had this major gap up on the daily chart. So if we go ahead and draw a line there on this chart, you can see that a few months later, that price level started to act pretty perfectly as a level of support, not only on one occasion, but actually on two occasions before it had this massive spike up all the way up to nearly $11 per share. Now, obviously, you're not going to see, 200, 300, 400% returns every time you see a gap close reversal in the stock market. But this is a really great example of how accurate this strategy can be for not only blue chip stocks, but also for these lower priced penny stocks, which can, of course, offer us huge returns in certain occasions. So if we go ahead and remove this line now and fast forward a bit, there's actually another great example here on this same chart for DPW, actually on the day that it had this massive gap up. So now this time, the gap close reversal point is going to be in the low twos, at about $2.10 per share. So if we go ahead and draw that line, again, you would look for that price as an opportunity to buy into the stock for a swing trade. And you can see just a few weeks ago, as the price closed that gap, it started to bounce back up from about $2 per share all the way back over $3 per share, which compared to the previous spike from a couple of dollars all the way up to 11 may not sound like much, but that still is potential for over 50% return just by looking for this gap close reversal strategy and by buying in at that level of support. Okay, so with all of that being said, the one and only downside to this strategy is that, in my opinion, it can be very difficult to find these setups in the market because a lot of times when we're looking for day trades or swing trades, what we do is pull up some kind of scanner or some kind of screener and we type in the criteria that we're looking for in order to get a list of stocks that are specifically meeting that criteria. And because we're looking for these gaps that can happen, months ago or even years ago, it is very difficult to put that criteria into a scanner and actually find these stocks in real time. So in my opinion, even though this is a great strategy, it's kind of just one of those ones that you don't necessarily actively look for. But instead, once you see a big gap on a daily chart and the price is starting to close that gap, you simply look to take advantage of it when that time comes. Okay, so that's going to be a wrap for this quick video on swing trading and the gap close reversal strategy. Thanks for watching, and I hope you enjoyed and found this video helpful. If you did, please make sure to give it a like and subscribe to the channel so you don't miss out on future videos and future trading lessons. And of course, if you're looking for more information on day trading, swing trading, and even long-term investing, including all of the basics that are very beginner friendly, as well as other more advanced trading and investing strategies, all of that can be found on my website, Master the Market, which is going to be linked down below in the description. But anyway, thanks again for watching and good luck with your trading.